You've probably heard that the US dollar is losing its throne. BRICS are talking about rival currencies, oil is being sold in yuan, and central banks are said to be dumping treasuries. If all of that really adds up, it's the biggest financial story of your lifetime. But how much of this is a real power shift and how much is just noise? To see the difference, we need to look at the parts of the system that actually matter. Three flows tell the real story: the currency of trade, what central banks hold as reserves, and who supplies safe assets. Once you see how those three fit together, the de-dollarization story looks very different from the headlines. Start with what the dollar actually does today. In global finance, the dollar plays three roles at once. It's the main language of trade contracts, it's the main asset central banks hold as reserves, and it's the main safe asset the world hides in when things go wrong. These three roles feed each other and turn the dollar from just money into infrastructure. De-dollarization is simply countries trying to reroute parts of that infrastructure. So how far have they really got? Let's start with trade. Most cross-border deals still write USD on the invoice, even when the US isn't involved. But the edges are changing, especially where countries feel exposed to US power. Russia shifted much of its trade away from dollars after sanctions, first to euros, then increasingly to yuan and local currencies. Some oil deals now settle in yuan, and India has experimented paying for Russian oil in rupees. These trades are a small share of global volume, but they show where the pressure is. In trade, de-dollarization is real but still regional and driven by stress, not yet a smooth global switch. Next, look at what central banks keep as reserves. Reserves are a safety net, money countries save to defend their currency and pay for imports in a crisis. For decades, most of that safety net was dollar assets, mainly US Treasuries. Around 2000, about 70% of reported global reserves were in dollars. Now it's closer to the low 60s, even high 50s. The gap has gone into euros, other currencies, and increasingly into gold. Gold can't be frozen or defaulted on in the same way as someone else's government bond. The turning point was when Russian reserves were frozen in 2022. Every finance ministry noticed. That doesn't lead to instant dumping of dollars, but it does change the direction of travel. Over the next decade, expect central banks to hold slightly fewer dollars, more alternatives, and more gold. So trade and reserves are shifting, but the deepest layer is who supplies the world's safe assets. A reserve currency needs a massive pool of bonds that global savers trust and can trade in huge size. In practice, that means the issuing country must run big, long-lasting deficits with the rest of the world. The US has done this for decades, and the world has been happy to store its savings in US debt. Europe has never fully built an equivalent euro safe asset market. China has the size, but capital controls, politics, and its export model limit how far yuan assets can go. That's why, deep down, the dollar still has no full replacement as the world's main safe asset supplier. Put it together, in trade, the dollar is losing some share at the edges. In reserves, its share is slowly falling. In safe assets, it still dominates. So far, de-dollarization looks more like gradual diversification than a clean regime change. What could turn this slow drift into something much faster? The biggest vulnerability is that the dollar system is tightly tied to US foreign policy. The same plumbing that makes the dollar powerful in markets also makes it a powerful sanctions weapon. For countries that fear they could be targeted, that's a strong incentive to build escape routes. The one shock that could speed up de-dollarization is a mix of two things. First, a major confrontation where the US uses the dollar system so aggressively that many neutral countries feel they might be next. Second, a visible crisis inside the US itself, like a messy debt default scare or extreme political dysfunction. Either one alone causes noise. Together, they could push many countries to accelerate their exit plans. In that world, regional payment systems, local currency trade, and gold accumulation suddenly move from side projects to priorities. You still wouldn't get a single new empire currency replacing the dollar overnight. Instead, you'd get a more fragmented system with several blocks and several important currencies. Practically, that means more complexity and more currency risk for businesses, investors, and governments. So where does that leave the dollar? Most dramatic claims, dollar collapse, instant BRICS takeover, ignore how slowly financial infrastructure really moves. But saying nothing will ever change also ignores how quickly politics can reshape incentives. Trade invoicing, reserve choices, and safe asset supply are slowly pushing us from a unipolar dollar world towards a more multipolar one. How fast we move depends less on market gossip and more on a few big geopolitical decisions. If you want to really track de-dollarization, watch the quiet data: trade invoicing, reserve reports, and bond markets. Those flow lines, not the loudest headlines, will tell you whether the dollar stays dominant or becomes just one big player in a new system. This is Global Flowlines. If you want clear, long-term views on how money moves around the world, consider subscribing.